The stock market is breaking records. The S&P 500, NASDAQ, and even European indexes are hitting all-time highs. But is this really the right time to invest? Or are we on the edge of another drop? In this video, we'll look at the key factors that actually matter before deciding where to put your money. Like, comment, and share this video so more people can invest with clarity and confidence. Current state of the stock market. Markets are buzzing with excitement. The S&P 500 surpassed 5,600 points in June 2025, driven by big tech companies like Nvidia, Apple, and Microsoft. The NASDAQ also hit record highs, reflecting optimism around artificial intelligence, clean energy, and new emerging sectors. This boom has sparked upbeat headlines and drawn in a wave of new investors. In fact, several brokerages reported a 30% plus increase in new account openings in just the first quarter of 2025. That shows people are paying attention and eager to ride the growth wave. But with new highs come big questions. Is it too late to get in? That's a common and valid concern. Many fear buying at the top and watching their investments plummet right after. That's what happened to people who bought crypto in 2021 or tech stocks back in 2000. It's natural to be cautious, but letting fear freeze can also hold you back. To decide smartly, we need to go beyond the headlines. Let's break down the real economic forces shaping the market and directly affecting your investments. Only then can you make informed choices, guided by facts, not emotions. So let's dive into the pillars that are holding up or threatening the current market outlook. Key factors TO consider before investing. Before you invest, it's crucial to understand what's driving the markets and what risks are on the horizon. Here are 4 key factors you need to keep in mind. Chasing hype or copying ready-made portfolios won't cut it. Understanding economic fundamentals could be the difference between growing steadily or walking into a bubble that's about to burst. Inflation, the silent enemy. Officially, inflation looks under control. 2.4% annually in the U.S. in 2025, below expectations. But the numbers don't tell the full story. If we look at total inflation since 2021, prices are up over 23%, while wages grew around 20%. That small gap means real purchasing power has shrunk. People are spending more just to maintain the same lifestyle. Here are some real-world numbers. Average rent in New York, $4,100 per month, up 18% since 2022. U.S. household electricity bills, plus 12% over the past 12 months. Car insurance, up 19% in 2024 alone. Dining out, restaurant prices up over 14% in cities like London, Paris, and Toronto. These increases hit the middle class and small investors hardest, tightening budgets and leaving less money for investing. On the other hand, some sectors, like fuel, airfare, and electronics, have seen deflation due to lower production costs and rising competition. But that doesn't cancel out the spike in essential services. Bottom line, inflation still influences consumption, investing behavior, and monetary policy. The Federal Reserve remains cautious about cutting interest rates too soon, worry about triggering another inflation surge. That keeps fixed income yields attractive and puts pressure on stocks. Summary: inflation is more under control, but still distorts prices and purchasing power. It's a key factor in deciding whether to invest now or wait. Trade tariffs, the political game that affects your money. U.S.-China trade tensions are back in the spotlight. And when tariffs hit, the impact goes far beyond foreign policy. It hits your portfolio. President Trump announced tariffs of up to 60% on Chinese products, including electric vehicles, electronics, and industrial inputs, sparking a new trade war with global consequences. The Treasury Secretary also said a new trade policy will be unveiled in July. This could cause big market swings, especially in sectors like automotive, technology, agriculture. Tariffs act as a brake on the global economy. They drive up import prices, squeeze profit margins, and add inflation pressure. The more uncertainty in global trade, the more cautious large funds become. For investors, tariffs mean volatility, a chance for those who know what they're doing, a risk for those acting on impulse. It's crucial to understand how these moves affect supply chains, exporters, and institutional investor confidence. If you're investing in companies that rely on China, like Apple, Tesla, or Qualcomm, these shifts can mean either risk or opportunity, depending on how the market reacts. The economy, what the numbers don't always show, official U.S. unemployment is at 4.2%, seemingly healthy. But behind the numbers lies a more troubling picture, a rise in underemployment. People juggling 2 or 3 jobs. Record credit card debt, over $1.35 trillion, the highest ever recorded. High consumer spending, but fueled by credit. Not real income economy is running, but largely powered by debt, especially through credit cards, fintech lenders, and companies like Visa and Amex. The problem? This creates a false sense of stability. When interest rates rise or credit tightens, the whole system can start to crack, hurting businesses and stock values. Crisis and recovery history. The power of long-term thinking. Let's rewind. 2000 dot-com bubble burst. 2008, subprime crisis. Bank collapses and a global recession. 2020, pandemic. Markets crashed by up to 30% in weeks. Those who sold in panic lost. But those who held on, especially in index funds like the S&P 500, saw their wealth grow over time. As Warren Buffett says, time in the market beats timing the market. And the numbers back it up. Over 20 years, the S&P 500 returned an average of 9.7% annually, despite the crises. Missing just the 10 best days in the market over that time slashed returns by 40%. The takeaway? Markets reward patience and discipline, not fear. Smart investing strategies. Now that you know the risk opportunities, here's the big question. How should you act? ABB, always be buying. This philosophy, used by top investors, suggests the most important thing is to keep buying, regularly, especially if you're in it for the long haul. There are 2 main investor profiles. Passive investor buys ETFs or index funds like the S&P 500 or MSCI World monthly, doesn't try to predict the market, benefits from compound interest and long-term market growth. Ideal strategy for those with limited time or experience. Example, investing $500 per month in an ETF like VO S&P 500. In 20 years with average returns, this could grow to over $300,000, even with ups and downs along the way. Active investor studies trends, sectors, and economic data to find opportunities. Might focus on promising sectors like AI, clean energy, or aerospace. Requires more time, research, and analysis, but may lead to above-average returns. Current example, drone and defense tech companies are gaining traction amid geopolitical tensions. Investing before key tariff announcements could offer fast gains, but only if you're well prepared. Investor psychology and financial education. More important than picking the right stock is having the right mindset. This is what most beginners overlook and where most fail, not because they lack technical knowledge, but because they struggle emotionally. Don't invest based on emotion. Fear, greed, and anxiety are terrible advisors. Avoid chasing rumors or reacting impulsively. When you invest based on hype or panic, you're gambling, not building wealth. Successful investing takes a calm mind, even when everyone else is freaking out. Have a clear strategy. Set clear goals: retirement, passive income, financial freedom. Pick assets that make sense for your life. Without a plan, every market dip feels like a threat. With a strategy, every move becomes part of the process. It's like building a house, brick by brick with long-term vision. Financial education is key. Read, watch, study, invest in learning too. Top investors like Ray Dalio still study markets weekly, even after decades of success. Learning about macroeconomics, market cycles, and risk analysis gives you freedom. You stop depending on tips and start making decisions with confidence. Risk is part of the game. There's no such thing as a risk-free investment. But with strategy, diversification, and consistency, risk becomes manageable. Fear of risk holds many people back. But not investing is also risky. It means losing buying power and relying on others later. Think long-term. Markets test your patience, not your intelligence. Those who understand how the system works, interest rates, inflation cycles, invest with confidence, not fear. Remember, you don't have to be perfect. You just have to be consistent for long enough. That's how real wealth is built. Are stocks at record highs? Yes. Is now a good time to invest? That depends on you. By understanding economic drivers, building a clear strategy, and keeping a long-term mindset, investing now could be a great decision. Don't let fear or hype decide for you. Be rational, informed, and consistent. Enjoyed this video? Leave a like. Drop your questions in the comments and share it with someone who needs to start investing smart. Your financial freedom journey starts now. Click the link in the video description to unlock the ebook packed with investing secrets, mindset shifts, and wealth building strategies.